Thank you guys for tuning in today, and welcome to part 2 of our discussion with Bill Black. He's a professor of economics at law at the University of Missouri, Kansas City, and he's a former financial regulator, whistleblower, white-collar criminologist, and author of the book called The Best Way to Rob a Bank is to Own One. Bill, thanks for joining us again for part 2 of this discussion.
Good to be back.
Bill, we hear about all of these fines all the time, whether it's with Wirecard, we are expecting a fine to come in that regard, or whether it's Volkswagen, who received millions, if not billions, in fines. However, what we don't hear is who pays these fines. In other words, who shoulders the costs? Is it the shareholders, or board of directors, or CEO, or is it passed on to consumers? And secondly, are these fines sufficient enough to regulate the practices of big financial corporations?
So let's start with the last one, which is easy. No, not even close. The whole idea of fining corporations typically makes no sense. The only way you get effective deterrence is by putting the individuals in prison. Now, I'm not, as a criminologist, I don't want to put people in prison for 30 years, 40 years type of thing. But a meaningful prison sentence is the great deterrent. And we actually know this. There are famous quotations in the United States of CEOs and senior officials explaining, look, at anything you do to me by way of a fine, my company can make me whole, right? And the shareholders bear the cost, not the CEO, and the CEO makes the decision. So fines don't change behavior, hardly ever in a good fashion. So they're not effective. But the corporation can't make you whole against a term of imprisonment. And so that's exactly what we should do. And by the way, in economic literature, people got a Nobel Prize in part for saying the opposite. Hey, what we ought to do is wherever possible, only use fines against corporate elites. Gee, isn't that a shock that economics, mainstream economics, would lead to a system that and he said simultaneously, we need to put a lot more poor people in prison. That's economics.
What is the role of taxpayers, in all of this? When like, what I wonder is, when a corporation gets fined, does that money return back to the taxpayers and is, for example, used in building streets or whatever? Or what happens to these fines eventually? Or some have argued that these fines are actually not fines on corporations, but are indirectly then paid by taxpayers. Can you clear the smoke on what it means to fine a big bank or corporation or car company?
Okay, but it's a little complex, so it's going to take a while. Okay.
No worries, go for it.
Yeah, it depends on tax law, and it depends on how you impose the fine. So in the United States, in many circumstances, a fine is tax deductible. So yes, the taxpayer implicitly, the rest of us, not the company, end up paying a significant portion of that fine. And so that's a particular outrage. And there's a game that goes on in the United States, and I'm sure it goes on in other places as well. The Department of Justice wants to make the fine sound substantial. So it makes it bigger, but allows tax deductibility. Right? The corporation is willing to go along because it doesn't matter. It ends up in the same net place. The prosecutor looks good. They then go through the revolving door back to representing the corporations. Everybody's happy except us, type of thing. But we don't know what's been done to us, typically. And so all around the world, here's another thing about fines, especially the ones that sound big. Almost always the stock price of the company goes up in response to the
Why?
fine. Gee, it's almost like they're telling us something.
So the stock price goes up because they know that they're going to profit from it eventually, or?
Oh, they know that it's over. There's not going to be anything serious, right? It's like in you're playing football, soccer, and you just crush somebody's leg from behind, and the ref comes up and talks to you and doesn't give you a card. Or you do a leg breaking tackle and they give you a yellow. Okay. They're down their best player. He's gone. I'm still on the field. What's not to like, about this? So those are terrible things. And they catch the flavor. And that is why the stock market goes up. It says, hey, you got away with it. Nothing serious is going to happen. The typical huge fine to banks in the great financial crisis, and they sounded really big in the United States, that was 4 months of profits. 4 months. So even if the worst happens to you 4 months later, it's nothing. And on top of that, the United States dollar amounts, I told you the prosecutors like to inflate them. They superinflated them. They said, we're going to count in the press release your agreement to do what we call troubled debt restructuring. Troubled debt restructuring is a U.S. jargon, but it's probably meaningful everywhere. The bank would prefer not to go to foreclosure because it has lots of losses in those circumstances. So it cuts a deal and says, we'll stretch out your payments for 2 years. We'll lower your interest rate from 6 to 4. And you'll pay us, 80,000 euros instead of 100,000 euros, right? That's a troubled debt restructuring. And businesses do this all the time because it typically makes sense, right? So banks were going to do this anyway. And they were allowed in the United States in those press releases to say, and the bank's going to pay this much to resolve these problems. It's just pure propaganda, right? And when the Department of Justice or whatever its equivalent in other countries is doing that kind of propaganda, that it knows that it's not doing anything real.
Let us take a step back before these fines are levied, because usually to create barriers to fraud and corruption, we place in regulation. And whenever I talk to right-wing economists about regulation, they present us counter arguments, which I would like to go with you through one by one, and you'll get the chance to counter them briefly. So let us start with the first counter argument, which usually is phrased in this way: regulation does not work, especially for financial activities, given their complexity. Hence, for every regulation, they will always create more loopholes and opportunities around it to circumvent around it, making the regulation ineffective in nature.
Okay, that can be true, and it can also be the opposite. And so you need not just regulation. Regulation is never the answer. Competent regulation with real regulators, and we have neither. So we're 0 for 2 in that regard, and disaster. Let's take real examples. Right? In the prior segment, we talked about appraisal fraud. And we talked about liar's loans, right? So the old rule was on underwriting in the United States was the perfect rule. Why? It didn't try to be a best practices rule. It was minimal safe practice rule, right? And that may seem weird. So what we said, recall there's 3 C's: collateral, capacity, and credit. We said you have to do all 3. Whoa. Anybody prudent would do that. And we said you have to keep a record of it, an organized record, so we can examine it. Okay. And you have to verify the information. You don't just say, hey, tell me what your net worth is. Because that would be stupid, right? Now, any competent bank would far exceed our rule. So that the kind of economists you're talking about would say, they'd roll their eyes and go, what a stupid rule. Any honest banker would go far beyond, and any dishonest banker will violate the rule. That's the friggin' point. They would have to violate a rule. And when you violate a rule, you allow me as a regulator, if I'm a real regulator, which as I've said we don't have anymore, to actually enforce the rule. So you had bad choices under the old rule if you were going to cheat. Remember, the art of accounting fraud is to make massive amounts of bad loans because they produce a sure thing of fraudulent accounting income. So they have to gut their underwriting systems. So the first thing is this is a signal to us. Whenever we see utterly gutted underwriting systems, we know there's a catastrophe coming. We don't have to know that it's a fraud or a non-fraud, right? You could be the most incompetent people in God's existence. We have to stop you from that because you're going to produce a catastrophic loss. But far more likely is you're not the biggest moron in history. You're cheating like the other 300 that in the savings and loan debacle followed this strategy. 300 institutions, think of that, growing the slowest rate of growth among those 300 was 50% a year. So now with COVID, people understand, I hope, exponential, right? If you grow more than 50% a year, a COVID curve is 50% a day. So you get this, but this is what you get in finance. And after about 3 or 4 years, you're in the ski slope, the reverse ski slope situation, where every month you wait causes losses to go massively. So the signal to us as regulator to act and act quickly, that this is a priority, is immensely important. And so we kick it into high gear in this era and say, we know that you have to be stopped and we have to be stopped now. And because there's a rule, we can stop you because you had to violate that rule to be able to grow by destroying your underwriting, right? And you will do one of three things. One, you will report, hey, here's my loan files, and they show that I violated all of my own underwriting rules. In which case we go, you violated all of your own underwriting rules, and we slam you and stop you right away. Or two, you selectively remove bad information. And so your loan files have all these missing documents. We look, when there were competent regulators, and at a sample of those. And if overwhelmingly the information missing is negative information, then we draw a logical inference. You're trying to lie to us, right? And we slam you. And it's a violation of our rules to have done that, right, as well. Or third, you falsify documents. You forge documents, which is what Wirecard does. And that does fool people for a while, but it's actually harder to do wide-scale forgeries than people think. And we got good at looking for that. And when we catch you forging documents, does that make a good criminal case? That makes an ideal criminal case. So this rule proved spectacularly effective. We were able to drive 300 of these frauds out of the industry precisely because we had the rule and because the rule caused you to lie, and that in the United States context, lying to federal officials is a crime. That helped us convict over 1,000 felony convictions in the savings and loan debacle, hyper prioritized to the most elite folks, where we had a 95% conviction rate against the best white-collar criminal defense lawyers in the world, where the corporation will spend money like water to keep the CEO out of prison. So no, there's an empirical reality. We've run through this. If you do the right kind of rules, if you have real regulators, the rules not only can't be, yes, what I just described were 3 evasion techniques, right, of the rules. The fact that you try to evade doesn't mean you succeed. People in football, do shoulder fakes. That doesn't mean every defender falls down. When you have real Verteidigers, they succeed.
Talking about defenders or regulators, the other argument I hear is that regulation creates a catch-22 problem. And let me elaborate on this. The question becomes then, once you create regulation, which requires regulators, that who controls then these regulators, especially when we know, for example, that the government is influenced through revolving doors or lobbyism, or even by the fact that regulators develop connections when they're working on side with the people of the companies they're supposed to regulate. So what is your take on this argument?
Well, again, this absolutely has some truth to it, but it misses the real problem. The real problem is ideological capture. The real problem is that all over the world, all over Europe and the United States for sure, the regulatory leaders believe this utter nonsense from neoliberal economics, that fraud doesn't occur, markets are wonderful and are self-regulating, et cetera. And our job as regulators is to give the occasional speech and to go through the revolving door. People like me never went through a revolving door. You can hire people like this. So can you succeed? The guy that led this incredible re-regulation of the savings and loan industry that led to all these convictions was appointed by Ronald Reagan. He was a dyed-in-the-wool Republican, right, who believed in anti-regulatory stuff. He was confronted with the facts. And he was not the right stuff kind of guy, unflappable under pressure. He smoked like crazy. And he told us what he was doing in re-regulating the industry was going to destroy his career. He did it. He also went and said, we have two epicenters of fraud, in our case, Texas and California. Then he went to all the top people he could find and said, who are the two best supervisors in America, financial supervisors in America? He personally recruited them, put them in those offices to take them on, and they stopped this incredible wave of fraud where we had 5 U.S. senators personally hammer us, where the Speaker of the House, who is the second most powerful elected official in America, not the Vice President, made it his cause in life to hammer us, where a majority of the House of Representatives, with both parties' leaderships, co-sponsored a resolution saying, don't go forward with this re-regulation of the industry, where obviously President Reagan opposed the re-regulation of the industry. It still happened, right? So will it happen all the time? Of course not. Do you have to? War analogies are terrible analogies in regulation. There is never a decisive victory in which fraud is defeated and does not come back. Every generation has to fight this struggle. Every generation is going to have failures, in part due to this kind of capture. But you will find that government employees in places, particularly like the United States, Germany, lots of other places, are actually people that you would be proud to associate with, right? They will end their careers. And I have, in the US context, for example, that I told you that he recruited a top guy to go to Texas. That guy was gay. And this was the United States in 1986. He knew he was going to be outed. And he was ultimately pushed out by a successor, not the same head of the agency, obviously, but a successor on that basis. He took that job. He knew it was going to, Gray continued, though he knew it was the end of his career. One of Gray's successor, not the one who got rid of Joe Selby on the basis that he was gay, the Speaker of the House personally demanded his firing on the basis that he was gay, right? That's how times were. But one of the other successors, also appointed by a Republican, personally decided to bring an enforcement action against the president's son, knowing it was going to end his, what was at that point, really takeoff political and public sector career. He absolutely knew it was going to destroy it, and he did it anyway. If you seek courage, if you don't totally disparage, right now we assume failure. We preach failure. The public sector, it can't work. I can tell you from personal experience, it can work in extraordinary times in where it would seem impossible to succeed. But also I'll tell you our motto, which is from the House of Orange, right? The Nederlanders in their impossible struggle against Spain for independence of 100 years. It is not necessary to hope in order to persevere. We persevered.
And the last argument that I hear is, and you probably have heard this over and over again, but I think it's great to have an objective discussion on this. Strong regulation only leads to bureaucracy and gives the state more and more and more power over the economy, which eventually leads to centralization instead of an economy based on dynamic individual liberty and freedom. And hence the difference between the market and the public sector starts dissolving, which then leads to, in the worst case, a fascist or centralized state, which does not produce, it's not productive. What is your take on this?
Right. In the first segment, we referred to this as the road to serfdom argument of Austrian economists and such. And you can imagine such a thing, except absolutely no liberal, progressive European state has ever done that, nor has the United States, right? But the reason is they're fundamentally wrong about their premise. Effective regulation doesn't mean lots of regulation. What did I tell you about the underwriting rule, which, by the way, has still never been restored, right? And that tells you an enormous amount. The underwriting rule is the perfect rule because it is in part so limited. It causes zero additional cost to honest lenders. Effective rule of law is enormously in the interest of honest members of the market. It is the only thing that can prevent the Gresham's dynamic. So yes, could you imagine adopting rules that were so horrific they caused business breakdowns, and that led to more rules to try to fix the government breakdown, and that eventually led to a complete breakdown of the economy and fascism? Yeah, thanks. It's that the book has been written, Road to Serfdom. It hasn't proven correct to come. It hasn't proven remotely correct. But you can at least, yes, you can think of that. You don't have to go those route. I got rid of more rules. At the staff level, I was in charge of the re-regulation of the savings and loan industry, which prevented it from becoming even remotely a financial catastrophe. Right? It was costly. It was terrible, but didn't produce any financial crisis, of large banks failing or any of those types of things. Because we weren't there to regulate, we were there to be effective. And as I said, the best rules are often incredibly non-threatening to honest manufacturers, but incredibly threatening if you use them correctly to the dishonest. And the people, the economists that are talking, they just act like all regulation is the same, right? This is just a single word. That's insane and tells you that they don't understand what they're talking about.
That was a very interesting take on regulation and a very differentiated one, but I would like to switch gears now and talk about the financial sector. We saw a phenomenon of a true track economy emerge during the COVID-19 lockdown. While the real economy was put on hold, the financial sector continued to do business. And the question I asked myself is, how is this even possible given the perception that many have, and which I learned in college, is that the financial sector, as the word implies, is just a sector of the real economy, and therefore any or no activity taking place in the real economy would directly be related to the financial sector. The less happens in the real economy, the less would happen in the financial sector. Could you talk about this phenomena and what the real role of the financial sector is?
Yeah, but I think it's going to take an additional interview to do it remotely justice. So, yes, the standard neoclassical thing is that finance exists simply to help the real economy, and it simply allocates credit in the optimal fashion to whoever can use it most productively. Now, if that were true, you would see productivity doing wondrous things. So Paul Volcker, who died recently, was but the most famous person in finance, famously said that the only financial innovation in the last 50 years that had proved worthwhile was the ATM. In the U.S. context, that's how you get cash. Americans still use cash to a greater extent than Europeans do. But his point was all these other supposed innovations not only hadn't proved useful, they had typically become unuseful. So that means finance, under neoclassical neoliberal theory, finance is a middleman, right? And the efficiency condition for a middleman is very clear. In US jargon, it'd be mean and lean, right? Really tiny. Because we're just an intermediary. In fact, that's what we're called, financial intermediaries, right? But just before the Great Depression in the US context, and just before the Great Financial Crisis, 40% of total corporate profits in the United States went to finance. So instead of this efficiency condition, this middleman is taking huge profits. And that's the first part. The second part is the rap on finance, which is quite true, is you asked about stockholders earlier. Finance isn't run for stockholders. Finance is run for the employees. It's just that the employees ain't you and me, little guys and gals. It's the folks pulling down millions of dollars, literally a year, right? They make all the decisions and they run it for that. So finance doesn't have anything to do with what you were taught in school. Now, the next thing is finance has become enormously perverse. We've gone through some of the reasons. The accounting control fraud in particular, where you deliberately make massive amounts of bad loans. And then what do you do with bad loans? How do you keep them from blowing up? Well, as long as the bubble is expanding, all you do is refinance the loan. In America, we call this poetically, a rolling loan gathers no loss. To roll a loan is to refinance it. In Germany and rest of Europe, you typically call these evergreen loans, right? But that means as long as the bubble expands, I can keep a terrible loan, a la Wirecard, going for 15 years. And that's why when you asked me earlier about are we about to have an imminent collapse from this, no, but that's sort of the bad news. The bubbles are expanding. If they expand for 15 years, the losses get so great that they bring down massive financial institutions. So that's a problem. The second problem, though, is that finance now systematically misallocates credit to the least worthy endeavors. And it does that through a series of pathologies, but mostly it's typically summed up as short-termism, right? That they want their return now, and they don't care whether it's real or not. So accounting fraud is just great, right? As long as the stock goes up. And so as a footnote, stock markets and real economies have next to nothing to do with each other. Maybe over a 30-year period, they have a bit, but they have increasingly little to do. And the differentiation is because of these pathologies. So if we want to stoke a bubble, and there's a president of the United States who really, really, really wants to stoke a bubble in stock prices because it's his big thing, what would we do? Who overwhelmingly puts their money in stock? Not the lower class in America, they have no stock. Not the middle class, they have a little bit in their pensions, if they have pensions still. The wealthy in America put the great bulk of their money in stock. Where did the tax cut go? $1 trillion tax cut go? Well, what's going to happen if you give a ton of money to the wealthiest people? They're going to invest it in the stock market. What's going to happen to stock price? Duh. It's going to go up enormously. Well, I'm a CEO and now I have perverse incentives throughout the productive sector. Where did we get these incentive structures from first? Finance, right? All this performance pay. But performance isn't real performance. It's accounting. It's short-term reported, not actual accounting. I hope we've gone through why reported accounting is often not real. Well, how would I goose my short-term number, right? How would I inflate it? Well, there's regular fraud, but on top of that, I could buy back my stock, right? I take corporate funds and I buy stock. What happens to stock price? Stock price goes up. Would I want to do a lot of research and development? You know, the thing that's supposed to create productivity and which is supposed to create wage gains that are non-inflationary, the stuff you were taught in economics? Hell no, that's risky. That takes years to produce profits, and often it fails. So I'll cut back on research and development, right? So we've created these incentive structures to do incredibly stupid things, and I'll move money so I recognize income this quarter and expenses next quarter, right? This is GE in the US context, all kinds of accounting scams, frauds, really, let's use the right word. And GE had this record period under Jack Welch, and he became the guru that everybody read, all those stupid books in airports, right, about how to make a fortune. And his system was these compensation incentives and this hiring system under which you fired 10% of your people every year and gave the super rewards to the 20% who were your lackeys, who would do, you know, basically the kind of scum that follow Trump around, right? And then, you know, they would be rich and they would therefore be successful. All of these things create long-term poverty and short-term fictional income. And so that's what finance has done, and it shows up in the numbers. Remember, economists sold us all these changes: performance pay, rank and yank where you fire the people, the tax cuts. All of these things were supposed to lead to enormous gains in productivity. In fact, productivity has been reduced about 40%. All of them were supposed to, in the United States, but actually through most of Europe as well. And all of these things were supposed to lead, therefore, to big wage gains, right? Except that wage gains used to track productivity like this over like a 70-year period in the United States and other European countries. And you know what? This is what wage gains look like now compared to productivity, but also productivity has fallen. So they actually look like this. So all of these things that you were taught in your neoliberal economics were obvious, correct, and productivity enhancing, and finance was there to be private market discipline, right? It's very German. Right? Alles muss in Ordnung sein type stuff, and finance will keep us in order and have discipline, right? All of that has caused catastrophic loss of productivity, catastrophic loss of wage gain, and enormous dangers through global climate disruption. So it is just a terrible track record, and complete with myths attacking the public sector, right? That it can't succeed, and if it does succeed, and all these myths about deficits supposedly destroying the state, and the Constitutional Court in Germany deciding, you know, EU, what EU? We'll decide what the EU rules are, type of thing. And Brexit and the rise of Hungary and Poland's, you want fascist? We have real fascists. We have real elected fascists using COVID. If Trump weren't so lazy, we would have that in the United States. Fortunately, he's the laziest sleaze we've ever encountered.
So to my last question, what is the alternative? Because when I think about when Trump's government bails out what they call massive restoration of liquidity in the stock markets. He's actually bailing out the richest segment of the population, which he also gave the tax cut, which obviously keep him in power for the next election. And he then sells this as, like Obama did, as whenever the stocks go up, as something that the economy is doing well while the masses of people are suffering. But what is the alternative? I mean, if he was not gonna restore liquidity in the stock markets, then it's like a cancer patient that needs this sort of drug to stay alive, because the alternative treatment would kill it, because now the stock market has grown so big and what people call too big to fail, that any sort of change, like if Trump would have just let the stock market fall and then helped the poor people out in the local economy, maybe had a job guarantee program or even a basic income, still the stock market would have collapsed, which would have destroyed the real economy. So are we now left in a position where the only way out is for a financial crash to come? Or do you believe that even though the stock market, the financial sector has grown so parasitic, that there's still a chance to reform it? Where do you stand on this?
Okay, that was a bunch of questions as a conclusion. So first, I don't accept the premise that if the stock market would quote unquote collapse, and that if it did, that would destroy the real economy, right? And we haven't differentiated between the fiscal bailouts and the Fed. And the Fed is much larger. And by the way, it did have some resonance to the great financial crisis. In other words, there were liquidity problems happening in some markets. And when liquidity problems happen, then what are called the market makers that make markets kind of work, they go bankrupt. And then the market fails. If a market fails, you can't sell. What's the price of assets? That really does get into some very nasty stuff. So Fed liquidity aid should come at a cost, right? Under any theory, we're making providing a huge benefit from the public sector, and we're not getting paid for it. Would the private sector do that? No. So we need to rethink that. Yes, we needed large-scale fiscal intervention, not for the stock market. The stock market is massively overvalued. That's dangerous. That's bad. That means it's systematically misallocating capital. So your professors weren't wrong that allocation of capital is important. What they missed is it's terrible, right? Under their system. And so we're systematically misallocating capital. We have to fix that for the reasons I've talked about. That's not the same thing. We have many things that we have to do to fundamentally change these things. We have to get rid of institutions so large that if they fail, they bring down the whole system because they hold us hostage. Yeah, I don't know if you've ever seen the movie Blazing Saddles. It's when the sheriff points the gun at his own head and says, "Don't move or I'll shoot," to the lynch mob. It's a black sheriff in the U.S. context type of thing. Hilariously funny, but that's what they really do all over Europe and the United States, and some times in Asia as well. So yeah, give me time. There are tons of things that we need to do in each of these different sectors. We have not little problems and not surface problems. You know, this discussion of systemic racism, we have systemic racism in our economic system as well, but we also have systemic instability built in. We also have systemic misallocation that impoverishes all of us. Remember, the right used to always promise us, yeah, maybe you're not getting a big enough slice of pie, but look, the pie keeps getting bigger. And so you end up better. No, the pie would be much bigger if we didn't do these things. Let me give you an example. My wife and I write together sometimes about women in the economy. Every study shows that if you have more women, honest business successes grow. So under any neoclassical economic theory, we don't have to, as the public sector, fix that, right? The market will fix that. They'll go get women will be more profitable. So the gender wage gap must be falling dramatically, right? It's actually increasing in the United States, right? For all women who have at least a collegiate degree. So why do we actually have to force this else? It isn't so much about sexism. It's more, there are too many guys at the top running scams. Are you going to hire women if you're running scams? No, you're going to hire guys. And every guy knows why, right? Every guy knows why this is going to happen. And so we call it the canary in the coal mine, right? The treatment of women. And this is one where there's a natural alliance between good guys and women. That would improve the economy. Business performance would go up. You know, we are not doing win-wins. And we're not doing win-wins because of these elites who benefit by doing things that harm the world. It isn't just that they enrich them. I'm less worried about that kinds of inequality. You produce the greatest product in the world. It adds to to life. I don't care that you end up a millionaire. In fact, I think that might be a pretty darn good thing. But when you do that by doing sleazy things that hurt people, then it enrages me. And then it has this danger, as I've talked about. I hope everybody learns this phrase, Gresham's dynamic, and takes it to heart. Because effective regulation, effective government, and that doesn't mean more regulation necessarily. It means more intelligent regulation. It means putting regulators in who actually believe in doing the right thing and who have the courage and who are willing to lose their jobs and never be employable. A journalist, pretty famous one in the U.S. context, because the Obama campaign filmed one of its advertisements the first time around, right? One of its advertisements in the living room of our house, because John McCain was the opponent. And John McCain was one of the 5 senators, the Keating 5, that went to bat for the worst fraud in the savings and loan debacle against us, the regulators, right? So this journalist is going, well, you just did this big ad. They sent it out to 6 million people and such. When are you going to get your senior position in the Obama administration dealing with this great financial crisis? I mean, you guys put 1,000 of them in prison. You led the re-regulation at the staff level. Surely you're going to get a high-level position. And 8 minutes later, when I was able to stop laughing, I had to explain to him that 325 million Americans would have to die before they would ever give me any regulatory authority again. So we are systematically putting the worst people in, and the Trump administration simply is the proof of our family rule that you can't compete with unintentional self-parody, right? Trump, I've got all the best people. These are the scum of the world, but they're also the incompetent of the world, right? There's not a single one of them that you would hire, even if you wanted to do something evil but intelligent. Right? They're just dumb. They're ex-cokeheads. They're just fundamentally corrupt. So we have to change the view, and the view on the left as well. The triumph of the right is that the left now believes that there's nothing government can do effectively, right? And they go from the correct point. You can't simply trust it. That's true. It takes constant vigilance and activism and effort to get the public sector to do the right thing a higher percentage of the time. That's absolutely true. But that's what we need to do.
Bill Black, white-collar criminologist and author of the book, The Best Way to Rob a Bank is to Own One. Thank you so much for your time.
Thank you.
And thank you guys for joining us today. Don't forget to subscribe to our YouTube channel by clicking on the bell below and to donate so we can continue to produce independent and non-profit news and analysis. I'm your host, Zain Raza. See you guys next time.